Are you ready for the hot seat?
Welcome to In the Hot Seat with the Tenney Group. I'm Spencer Tenney. It's good to be with you. So, does a sell-side Q of E actually deliver more value at close for business owners? We're going to find out from a special guest, Ryan Doler, Financial Due Diligence Director at Baker Tilly. Ryan, welcome to the Hot Seat.
Thank you very much. Really appreciate you having me.
All right, we're going to heat things up here in a minute, sir. But before we do that, why don't you just take 30 seconds, tell us a little bit about the work that you're doing for Baker Tilly.
Sure, yeah. No, I'm a director here at Baker Tilly. I sit in New York City, but originally came from Southern California. Spent most of my life in Southern California, Orange County specifically. I've been with Baker Tilly for almost 8 years now. And before that, I was an auditor for 7 years. My time at Baker Tilly, I've been doing exclusively transaction services, financial due diligence, quality of earnings work. And I lead our automotive and transportation deal practice. I like to say I'm the deals on wheels guy. Anything really where the where the rubber hits the road.
Now, if you would have told me that, I would have made that part of the hook when we got in here. But you might want to lead into that. That is a good hook as far as on your LinkedIn profile or whatever else it is. So let me get in here. Part of the, how we got to this point, longtime friends of ours, Moss Adams, doing tremendous work as an industry specialized CPA firm, merger with Baker Tilly over the past year. So I think this is very interesting for a variety of different reasons. Number one, because so many of our clients and business owners across transportation, logistics, and the supply chain are also merging for similar reasons. And so what can you share with us, that's not confidential about, like, what were some of the drivers of why this transaction between Baker Tilly and Moss Adams took place?
Yeah, no, that's a great question. I think really the merger was about stay relevant in a pretty rapidly evolving industry. The merger gave us scale and a deeper specialization, not only in what I do, broadening that, but also across the firm, adding practice groups that we never had at Heritage Moss Adams. And it gave us a national footprint as well as international. It made us the 6th largest CPA firm in the United States, which is great. I mean, it allows us to compete with the big boys, but we're still middle market focused. We're small cap, probably deal size of as low as $20 million to generally as high as $200 million. But I mean, we dabble in the billions too. It's there's really not a deal that we would touch. But I think clients today they're dealing with more complexity in their business. There's a lot more regulatory pressures, capital market activity, and then technology disruption from AI. And they really just need advisors who can bring both that deep expertise as well as the broad capabilities in industry as well as kind of the practice areas that they need help with. So I think what the combination did was it gave us a platform, and it allowed us to deliver a deeper level of industry specific insight at a much larger scale, but still staying middle market, still staying that kind of client centric focus. And it is a response to kind of the increased consolidation across the CPA firm. I mean, I think like you mentioned, we're seeing it in transportation logistics. We're seeing a lot of companies, and a lot of that's driven by private equity investment. Baker Tilly not excluded from that.
Yeah. I think I think like there's a lot of application here. And so I think what advice could you pass along to some of our folks that, maybe not distressed, but it's kind of overwhelming, the amount of like how fast the industry is changing, both in technological ways, but also regulatory pressures. We often say, this is not your granddaddy's trucking industry anymore. And so I think that people are having to kind of reinvent themselves. Some are thinking about exiting, some are thinking about acquiring. What advice would you give them about merging? Because merging is kind of like that third often resisted option that people don't really want to do. They're like, I don't know if I could kind of mesh well with someone else? What advice would you give to them as they consider and continue to explore their own strategic options?
Yeah, that's yeah, it's a good question too. I had a boss that told me hire good professional advisors and pay them well, and I think that's probably one of the best pieces of advice I can give people. You know, these guys they've run this business. A lot of them are founder led, owner operators of these businesses that built something from nothing, and this is their baby. And at the end of the day, you know, they're trying to figure out some sort of exit plan, and hopefully they have a strong succession plan in place. Um, you know, and that's where we also come in on that, is helping with that strategy, helping them, you know, determine what is their exit plan. Is it some sort of succession plan with family, or kids, or whatever have you, or is it an actual liquidity event, some sort of exit from the business? And you know, having a good advisor, whether it's investment banker, whether it's attorney, whether it's CPA, they can help you find, you know, the right fit for your business. If you are concerned about, you know, your business selling to, you know, some sort of faceless corporation that doesn't have, you know, the same culture as maybe your company and the values of your company, you know, your investment bankers can kind of suss that out and help and find the right fit for your company going forward. And even if you know, want to have some sort of rollover equity or something like that, some sort of a partner that is willing to do that, keep you on, have some rollover equity, and you continue to run your business with just more growth capital.
No, I appreciate that. No, you for a while you've been on the transaction advisory side, both at Heritage and now at Baker Tilly. You know, for those business owners that when they think about their CPAs, you know, they have a very specific idea about what they do or don't do. What are some of the common misconceptions? I mean, even your title, some people don't even know that exists as far as having a diligence director at the table during M&A. So like, what would you say to that person to kind of clear that up? What's the most common misconception about what you're doing when you're specifically serving business owners around an M&A transaction?
Yeah, I think for people that don't know, when I tell somebody that I'm an accountant, the first question they ask is if I can do their taxes. That's usually what people think about an accountant. And my answer is no, absolutely not. I use TurboTax myself, so I definitely cannot do your taxes. I have no idea. I mean, you know, dangerous familiarity with it, but that's it. But yeah, I mean, it is an interesting field. I mean, this quality of earnings, financial due diligence, really hasn't become mainstream until, I don't know, the past 15 years or so. And even at that, it was usually buy side only. You know, somebody wanted to acquire a company. You know, you have a fiduciary responsibility as, you know, an investor to deliver to your you know, your board, or as a, I should say, as a fiduciary, as a manager, to deliver to your investors, you know, a good transaction that is going to, you know, help grow the company and make them money. And it's no longer the handshake deals of the past. It's, you know, you have to go through the process. You have to do the due diligence and prove to somebody that you actually, you know, looked into this company in a meaningful way. Now, you know, I think within maybe the last 7 to 10 years, sell side quality of earnings have become a lot more prevalent, and having those to prepare you for the deal and prepare you to go to market, get the greatest value out of your business, help kind of put everything out there for a, you know, potential buyers, so they know what they're getting themselves into before they even, you know, sign an agreement and have that, you know, 30, 60 day locked in LOI exclusivity period there. They know kind of all the pitfalls. They know about how much they're paying, and hopefully that kind of speeds up the process and gets it all moving. So, you know, in terms of, you know, what people don't really understand about it is the value that adds. You know,
Right.
because this is something that they don't do. They don't really know, what this world is. And so, that's where we partner with, investment bankers and attorneys, people that are kind of the front line, as well as their tax accountant. Usually a lot of my referrals come in from, internal from Baker Tilly tax accountants who, hey, they've been talking to their client about succession planning and, want to get out. And so they make an introduction to me.
Yep.
And,
Well, let me just pause there for a second because I want to make sure that that we capture some of the meat around this. There's I tease this on the front end. Now for outsiders who may be less familiar with for M&A or some of the trends that we're seeing specifically around Q of E, well, they say, oh, of course, that's what the buyer does for their own diligence to make sure that to the penny that what the seller's representing matches reality. Okay, but the buyer pays for that. As a seller, why would I pay for that on the front end? Even if the seller probably is going to do their own due diligence, like that just seems like more cost. Why would I do that? So, Mr. Ryan, what would your response be to that?
Yeah, I think it's all about controlling the narrative. You want to be on your balls of your foot, not your heels, right? I think that's a common thing people say. It allows the seller to be proactive in identifying these issues, some of these like deal killing issues, have a good handle on their earnings and earnings for the purposes of enterprise value, for value in a company, are generally based off of EBITDA, earnings before interest, tax, depreciation, amortization. So unlevered, independent of the corporate structure, and without the cashless depreciation, amortization, and with that, it's very different than GAAP reporting, than financial statement reporting. The numbers can be very different, and there's a lot of things that we do to kind of marry those up. Usually we start as GAAP as the baseline, and then we move to the EBITDA reporting. But I spend half my life on the buy side, half my life on the sell side. And so, when I'm doing sell side due diligence, I look at it through that lens of like, what question will I ask if I were on the other side?
Yeah.
So, I'm really preparing a client for somebody like me who's going to be coming in and trying to beat down their financials, trying to, lower that enterprise value, that purchase price for their client. And that's really what, the sell side value is.
Yeah. Sometimes we talk about in terms of a positioning standpoint for our clients, it's often better to be different than to aspire or to try to present as the best. And I think this is especially relevant when you're larger transactions, highly prolific acquirers that are looking at multiple deals at the same time, great companies. So what are you doing that's allowing you to differentiate from the other offerings? And I think that where we've seen the QEV show up the most is where you have a great business, and like who often is going to get the capital committed? It's usually those that have already demonstrated that they have the least amount of execution risk to get to the closing table. So if someone's going to put a lot of hard costs, because once you go hard and you go exclusive, you start paying CPAs, you start paying attorneys, and if there's a discovery later on, they're not going to get that money back. So what we found is, and from a risk mitigation for buyers, if they've had that seller Q of E, and it's not for every size deal, but for a particular type of deal, it certainly helps to differentiate and de-risk that from the buyer standpoint. If we're going to go put real money around this and real energy, it sure is nice. It's going to have that vetting on the front end that we can trust this moving forward. Of course, we're going to do our own due diligence, but the fact that they've already done it certainly, reduces the probability that there's going to be any kind of discovery that would be problematic later on in the process. And so that's where we've seen it.
Totally. And for you too. I mean, when you're going to take a company to market, you guys, eat what you kill. You don't get paid till you sell, right? So,
Right.
investing a bunch of time with a company that is maybe a lower quality financial statements, has a harder time selling, takes you much longer, maybe doesn't even sell, maybe goes to market and there's just no interest, because nobody can really wrap their head around the financials. They can't wrap around, what's the upside to acquiring this company. So, we've seen a lot where investment bankers mandate every client they bring on, you have to get a quality of earnings. We want a quality of earnings. We want to use that as our baseline, so that when they go to potential buyers and they show them the sim, that was built off of the quality of earnings as sort of the basis, and they can look over their shoulder at me, and I can give them the thumbs up. Yep, this is I feel comfortable with these numbers. So yeah.
It sounds like you're trying to get me to mandate sell side QE.
Maybe.
That's what I heard. But hey, listen, I had a really interesting conversation, and this is company, a couple $100 million in revenue, great performer. Wasn't happy with their CPA. Looking at some other options, and I was just kind of sharing like. Our industry is not like other industries, specifically as it relates to this diligence side of things. Where is that true? When you're like in a transaction process, where does the fact that our industry and the things that we diligence, the things that come up in your world, what is unique about the transportation and logistics industry?
That's a really good question. I think there is a lot of things about this industry that are somewhat unique. I mean, I think it's for the most part it is highly fragmented still. It is asset intensive, so a lot of capital and a lot of depreciation expense too, if you're looking for the tax benefits. And I think they're pretty operationally complex. You have all sorts of things like fluctuating fuel costs. You have fluctuating shipping rates that spiked incredibly high during the COVID pandemic, and came back down a bit. But you have labor challenges, driver shortages, and then all the regulatory considerations with tariffs and whatnot. Plus, there's there's seasonality to the business too. If you're dealing with consumer products, there's generally seasonality. But you also have to worry about, shifting, consumer demand too. So, I think where we add value is understanding those aspects, understanding the impacts of some of these issues that the industry faces. The example I gave about the shipping rates, the container rates. I think understanding that, identifying, that this is an anomaly that probably should be normalized, should be leveled out for presentation, because it's not indicative of normal operating going concern business expenses. So we looked at that, and we would determine what's the average cost for a container, and recast the financials as if it was more a normalized rate, historical rate. So adding value, that's pushing up the EBITDA. A big thing too is, especially for buyers, is understanding if you're stepping into this asset intensive business, what's your commitments going forward on these assets, on these vehicles. What are payments going to look like going forward? Did they own? Did they lease? And from a seller's perspective, that's an important distinction too, because if they own, then they get depreciation expense, which is EBITDA neutral. That's an add back and doesn't impact their value. Where if they lease, that's an operating expense, reduces EBITDA, reduces enterprise value. So things like that, we want to make sure that we're properly addressing, we're normalizing it so that everybody can evaluate these businesses on a level playing field.
No, I think that's great. So what advice would you give to folks that, they're 2 to 3 years out from a potential exit from this industry? How do they, strategize around tax in the short term, but make sure that there's continuity upon exit? Like how should they be thinking about that?
Yeah, 2 to 3 years out would be great. I usually don't have that amount of time. I usually get brought in as somebody makes the decision, hey, we're going to be going to market in 2 to 3 months, and what can you do? So yeah, I mean, actually, if with 2 to 3 years planning, I think getting your accountant involved early is important. If you are looking to change your domicile where you live for tax purposes, I think that's something that has to happen pretty early on. And then getting your financials in order, doing sort of some sort of even red flags diligence where you're looking through or having somebody look through your financials to see if there's anything that kind of would raise any concerns from a transaction perspective, and that way we have the time. We have 2 or 3 years to correct this, because usually when we're doing a quality of earnings, we present about 3 years. It's usually 2 full fiscal years plus the most recent year to date period. So having stuff that goes back that is clean is better than having to go and explain to a potential buyer that the books were all messed up. We did fix it. We sort of fixed it outside of their accounting system.
Yeah.
But
We just got it together 90 days ago, and the rest not so much. I think that's good advice. What's different about when somebody just says, "Hey, wasn't expecting this, but unsolicited offer, we're going down this path." What's different about the advice you give in that context?
Yeah, that is a tough one, because we do run into those instances where they do have unsolicited offers. Oftentimes, they are caught unprepared, and somewhat have to rely upon the buyer's due diligence team that is, not on their side, right? I mean, they're being hired by the buyer to protect the buyer, and so I mean, where we add value the most in that is just being actively involved in the information being provided, helping review the due diligence as it's going through, and then helping them with some of the key deal terms. Oftentimes I'm brought in at the very end because clients don't understand what net working capital is. In a cash-free, debt-free deal, there's an expectation that the seller is going to deliver to the buyer a normalized level of net working capital, or short-term liquidity, and people don't understand how to calculate that, how to think about that from a transaction perspective, because the accounting finance dictionary definition of net working capital is strictly current assets minus current liabilities. But there's a lot of nuance to it from a transaction perspective, and certain balances are definitely gray area balances that are hotly negotiated. And so being on the front of that, being able to help with that actually adds dollar for dollar value.
Yeah. And no, it's so important. And I'm glad that you brought that up, because I think it's, something we try to get out in front of through our partners like yourself, to get an understanding about the role of this working capital calculation. It's not designed to be punitive, but it just is what it is. And so we have to kind of have a meeting of the minds on arriving at that calculation, and how to do it fairly. Yeah. Right. And so, I think that's excellent right there. Now, what about those that would be, thinking about, hey, we're going gangbusters over the next 5 to 7 years. We want to be on offense. We want to acquire. We want to explore possible mergers. How are you advising those folks? And what does that look like from a relationship standpoint?
Yeah, no, that's a great question, actually. I have a client that I'm working with right now that that's their situation. Actually, we helped them about 4 or 5 years ago go to market, and they weren't as prepared. They weren't prepared at all. They were very secretive about the whole process, understanding, but their financials weren't in order. We did a lot with them to get them in order and help them go to market. They had a really great offer, and they had a lot of business actually, coming down the pike, and they decided at the very last minute to call off the deal, and they wanted to focus on growing and trying to go back to market. And 4 or 5 years later, here we are. And I think everything that they learned through the process of originally, going through the QV and the pain points that they experienced of, not having a strong financial team that was aware of the process, that kind of knew what they were looking to do in terms of presentation for the transaction valuation financials for the company. They took that to heart, and they brought in a CFO that has specific transaction experience, a very strong CFO, and coached their senior accountant, who was the only one who was the finance person there before, and really they're doing a great process with it. I mean, they grew the business 3 times since we last spoke to them, which is great for them, and it's going to correlate to that much more that they're going to ultimately get at the end. They're fully prepared now, and that's the advice that I would give to a client of, back to what I said first. I mean, find good advisors and pay them well. Like, bring in good people to help guide you through this as early as possible.
No, it's a people ask me all the time, like, as a buyer, what's the number one thing, and I'll say, don't overpay. And, and so, obviously, on the QV is a big part of that, to make sure that what you're buying. And on the seller side, it's kind of, you only get one opportunity to facilitate the largest financial event of your lifetime, in most cases, for both of our clients. So it doesn't hurt to do dry run to kind of see if you're ready for prime time. So I really appreciate the insights, Ryan. Last question for you, sir, and thanks so much for all the insights that you've shared with us. So we talked about offline that you've moved to NYC over the last year, lifelong West Coast boy. I got to know, what is your favorite thing to do in New York? Being there a year now, what have you discovered about the city that doesn't sleep that is your favorite?
Gosh, I mean, the food, I think, is my favorite thing. It's always my favorite thing. I love discovering new restaurants and cocktail bars. I follow the best bars in the world list, and I think currently there's like 3 or 4 that are in the top 50 ranked in New York City. And, we have everything just so close and convenient. And I just love waking up on the weekend, and never thought that this would be my life, by the way. I, just still kind of blown away, but waking up on the weekend, going downstairs, walking over to get a bagel, and then walking over to Central Park and, sitting there and eating the bagel and maybe having some coffee. And it's a lot of fun. But yeah, the food is absolutely my favorite.
Sounds a little like the American dream, sir. Hey, listen, I really appreciate all that you do for our friends in the transportation and logistics industry. Appreciate you sharing your insights. That's going to do it for us in the hot seat. We will see you next time.
Thank you.